Welcome to the deep dive. We're here again, digging through, a whole stack of market intel, research, our notes, trying to pull out the really key insights for you.
Yeah, cutting through the noise.
Exactly. So last week, you might recall, we talked about Bitcoin hitting that incredible new all-time high. Big news.
Huge moment.
But today, we're actually going to take a step back, sort of zoom out a bit and look at how the market reacted after that peak. Because it's fascinating.
It really is.
We're diving into this, well, it feels like a paradox, right? Bitcoin, everyone calls it an inflation hedge, but then it pulls back.
Yeah.
Why? Because of hotter than expected inflation news.
Mm-hmm.
So what's really going on? Are these just short-term jitters kind of overshadowing the long game?
Mm-hmm.
Or is there something else happening? That's our mission today, figure out the deeper forces at play.
That's it, exactly. It's all about understanding that push and pull, right, between these immediate market pressures we've seen and, well, the really powerful long-term growth trends, the stuff that's fundamentally building out the Bitcoin ecosystem.
Okay, let's get into it then. This market activity. Bitcoin hits, over $124,000? Amazing. But then pretty quickly pulls back to around $115,000.
Yeah, a significant pullback.
And that move apparently triggered over $1 billion in leveraged liquidations. Now, I hear that, and I think, that sounds bad, right? A disaster.
You'd think so, wouldn't you?
So how are analysts mostly calling this a healthy correction? It feels counterintuitive.
It's a great question, and it really boils down to the type of liquidations we saw. The vast majority, like $866 million of that billion, that was long positions.
People betting the price would keep going up.
Exactly. Folks taking profits after that big run-up. Only about $140 million were shorts.
Right.
So it strongly suggests profit-taking, not, some kind of systemic weakness or breakdown.
Okay, that makes more sense.
And what's really crucial here, the derivatives market stayed remarkably stable through all this.
Stable how?
Well, the annualized premium on Bitcoin futures contracts, it just held steady, right around 9%.
And 9% is?
That's smack in the middle of the neutral range, usually about 5% to 10%. So it tells us the rally wasn't being fueled by, crazy, unsustainable leverage just waiting to blow up.
Right.
It really points to a more mature market, one that can actually absorb these kinds of shocks without completely falling apart.
So, okay, if it's healthy, maybe even constructive, where do things stand now? What are the key levels, the sort of battlegrounds for price in the short term?
Yeah, looking at the charts, technically immediate support seems to be holding around that $115,000 mark. It's getting help from the 50-day EMA, the exponential moving average.
Yeah.
We did dip briefly below $114,400, but buyers stepped in pretty quickly there.
So there's buying interest underneath.
Definitely. There are deeper cushions, too, around $112,000. And then the really major base, sort of the last line of defense you'd watch, is down near $109,000.
And on the upside, what needs to happen to get moving again?
To get some momentum back, we really need to clear $116,500 first. Then the next hurdles are $119,000 and, that psychological level near $121,000.
So it sounds like we're just chopping around for now.
That's the best way to put it. It's consolidation. And you'd expect volatility to sort of wake up again in this phase. Oh, and one more thing, the MVRV ratio.
Market value to realized value.
Yeah.
What's that telling us?
It's currently at plus 21%, which is, let's say, a mild danger zone for some profit taking. But importantly, it's nowhere near the crazy highs we've seen at major market tops in the past.
So not signaling an imminent crash, more like sideways potential.
Exactly. Suggests more consolidation, maybe some choppiness, rather than a big drop-off is the base case right now.
It really is striking how the market handled this compared to, say, a few years ago. $1 billion in liquidations that used to cause serious panic.
Oh, absolutely. Total panic.
What feels genuinely different this time around to you?
I think it's the resilience, plain and simple. In past cycles, a liquidation cascade like that, especially with so many longs getting wiped out, it often triggered widespread fear, a much deeper, longer downturn.
Because the leverage was maybe frothier back then.
Partly, yeah. And the derivatives market structure wasn't as robust. But here, you had the futures premium stay calm, you had the liquidations absorbed relatively quickly. It just signals a fundamentally stronger market structure.
So sophisticated players may be seeing dips as buys.
It seems that way. The asset's proving resilient against these external shocks rather than collapsing from, say, internal speculative bubbles bursting.
Yeah.
That's a key sign of maturation, definitely.
Okay, that brings us nicely to the bigger picture then. Those external forces.
Ah.
The analysis suggests it was macro stuff, not Bitcoin itself, that really triggered this recent pullback.
That's right.
So what was the specific news that kind of spooked everyone?
The main catalyst seems to have been the U.S. Producer Price Index, the PPI report, for July. It just came in way hotter than anyone expected.
Hotter how?
It surged 0.9% month over month. And while, interestingly, the main CPI, the Consumer Price Index, was actually a bit lower than forecast, when you dig into the details, like core CPI, and especially super core CPI, those measures that strip out the volatile food and energy, they actually showed inflation accelerating. That points to sticky underlying price pressures.
Oof. Okay, so stubborn inflation. How did that data immediately change what people expect the Federal Reserve to do? And why is that such a big deal for Bitcoin?
Right. Well, it shifted expectations almost instantly. Before that report, the market was kind of hoping for maybe pricing in 3 Fed rate cuts this year.
Yeah, I remember that talk.
Afterwards, that pretty much evaporated. The consensus snapped back to expecting only 2 cuts, maybe even fewer down the line.
And fewer cuts means?
It means interest rates stay higher for longer. And that generally does a couple of things. It tends to strengthen the U.S. dollar, and crucially, it raises the opportunity cost of holding assets that don't pay you anything, like Bitcoin or gold.
Because you could just hold bonds and get a decent yield, risk-free.
Precisely. So it creates this risk-off mood. Investors get nervous, they pull back from things they see as speculative, and that puts downward pressure on assets like Bitcoin.
Now, there was also this interesting, maybe slightly under-the-radar detail about tariffs playing a role in that inflation number.
Yes, absolutely. That's a really important thread. Trade specialists are increasingly connecting that PPI spike, and maybe broader inflation too, to U.S. tariff policies.
How so?
The idea is that companies were maybe absorbing those extra tariff costs for a while, but now they just can't anymore, and they're starting to pass them through the supply chain. We're seeing it in import prices and now producer prices.
And the Fed is noticing this.
They are. In fact, the Fed explicitly mentioned the inflationary risk from tariffs in their recent meeting minutes. So if this keeps up, if these costs keep pushing inflation higher, it makes it really, really hard for the Fed to cut rates.
Right, they'd be stuck.
Exactly. A Fed forced to stay hawkish because of tariffs. That creates a persistent headwind for risk assets, potentially drawing out this consolidation phase for Bitcoin. And this brings us right back to that paradox we started with, doesn't it?
The inflation hedge that drops on inflation news.
Right. What you're seeing is this conflict playing out in real time. You have short-term traders reacting to the Fed outlook, seeing Bitcoin as a risk asset that gets hurt by higher rates. And then you have the long-term holders, the accumulators, who look at this exact same inflation data and see it as validation for Bitcoin's whole purpose. You know, its fixed supply, its resistance to debasement.
So the market's basically arguing with itself about what Bitcoin is in this environment.
That's a great way to put it. These two powerful narratives are wrestling right now.
Okay, but despite these, let's call them short-term macro tremors.
Yeah.
The sources we looked at paint a really powerful counter story, which is this relentless march of institutional adoption. What are we seeing on that front?
Oh, it's undeniable. And it's accelerating. I mean, just look at BlackRock, world's largest asset manager, right?
Right.
Their crypto holdings blew past $100 billion this year. That's up, what, nearly $50 billion just since the start of the year.
Wow. $100 billion.
And a huge chunk of that, close to $90 billion, is in Bitcoin itself, mostly through their spot ETF. Now, okay, $100 billion is still less than 1% of their total assets under management.
Still a drop in their ocean.
But the sheer scale, the speed of that accumulation, it's massive validation. It creates this really significant, persistent buy-side pressure that wasn't there in previous cycles.
And it's not just a U.S. story either, is it? This is happening globally.
Exactly. We're seeing serious momentum in Europe, too. Like in Amsterdam, you've got MDAX, an asset manager, planning to list a new Bitcoin treasury firm on Euronext, designed specifically for institutions to hold Bitcoin long-term, like a reserve asset. And in Switzerland, Swiss Capital, a private bank, they're reopening their BTC Alpha Fund because demand is so high. They've got like 1,800 Bitcoin committed already, mostly from family offices, corporate treasuries, even before they officially reopened.
The sophisticated money is definitely moving in over there, too.
No question. It highlights a growing sophistication in the European market as well.
It really feels like this goes beyond just firms, adding Bitcoin to their balance sheet, like maybe MicroStrategy did early on. This feels deeper.
It is. It's a multi-layered evolution. We started with direct buying, yes. Then came easier access through traditional things like ETFs.
Right, the ETFs were huge.
Then investment in the infrastructure, the miners, the tech companies. Now we're seeing sophisticated managed fund products. And the latest phase, which is really fascinating, is this active integration.
Active integration, how?
Look at the partnership between they're an SEC-registered advisor, manage about $1.75 billion, and Figment, a big institutional staking provider securing like $15 billion in assets. They're teaming up to offer integrated Bitcoin yield strategies. So institutions aren't just buying and holding, they're actively using the asset within regulated frameworks to generate yield.
Ah, so making the Bitcoin work for them.
Exactly. That creates a much stickier demand. It's not just speculative buying, it's becoming part of their core strategy, much more resilient.
And another big piece making institutions more comfortable, surely, is regulation starting to clear up, right? Less Wild West.
Absolutely crucial. And we are seeing progress, definite progress towards actual frameworks, not just talk of bans. In the U.S., for instance, the Treasury Department just put out a request for comment on stablecoins under the Genius Act.
Okay, what does that signal?
It signals they're serious about building a federal framework. They're actively asking the industry, the public, how these rules should look. That process itself, seeking feedback, shaping the rules collaboratively, reduces uncertainty. That's exactly what institutions need.
And there was a really significant development potentially brewing in India, too. Sounded quite big.
Potentially massive, yes. India's tax authority, the CBDT, has started this comprehensive consultation with the crypto industry there.
After being pretty harsh previously, right?
Right. Extremely harsh. They have these, frankly, punitive taxes, like a 30% flat tax on any gains, no offsetting losses, plus this 1% tax deducted at source on transactions. It really stifled things.
Right.
But now they're asking really direct questions. Do we need a whole new law for digital assets? How should it be run? And crucially, they're asking about the impact of the current taxes or capital and businesses fleeing offshore because of them.
So they're acknowledging the problem.
They seem to be. They're asking how to create a level playing field. This proactive approach, actually talking to the industry, has created a lot of optimism. If India moves towards a more balanced, globally aligned framework, that unlocks a potentially enormous market.
It almost sounds like countries are starting to realize they need to compete for this business, not just shut it down.
That's precisely the dynamic. Outside of China, pretty much, the global trend has shifted firmly towards regulation, not prohibition. And that naturally creates jurisdictional competition. Countries want the innovation, the investment, the tax revenue that comes with digital assets, so they're incentivized to create clear, predictable, reasonable rules.
Which is good for Bitcoin long term.
Fundamentally bullish. It means more regulated on-ramps, more legal certainty, access to much wider international capital pools. It just systematically de-risks the asset class.
Okay, so we've got the market shop, the macro pressures, but then this huge institutional inflow and clearing regulation. Underneath all that, though, there's the tech itself, Bitcoin's actual network. What's happening there? Is it still evolving?
Oh, absolutely. There's a quiet but incredibly significant technological renaissance happening. This is the bedrock, really.
Like what? What's the big news?
One of the biggest is the official launch of the RGB protocol on mainnet.
RGB, I've heard the name. What does it actually do?
Think of it as a system for smart contracts and issuing assets like stablecoins, NFTs, other tokens directly on top of Bitcoin and the Lightning Network.
But Bitcoin couldn't really do smart contracts well before, right? That was more Ethereum's thing.
Exactly. RGB tackles that limitation. It uses this clever technique called client-side validation. Basically, transactions get verified privately, off-chain by the parties involved, but everything is still ultimately anchored and secured by the main Bitcoin blockchain. It brings programmability, scalability, and privacy.
Wow, okay. So you could have stable coins running directly on Bitcoin now.
Yes. And speaking of which, Tether, the biggest stablecoin issuer, USDT.
Yeah.
They just announced they're integrating with Lightspark's implementation of the Bitcoin Lightning Network. This means developers can build wallets for instant, almost free USDT transfers over Lightning.
USDT on Lightning. That sounds fast and cheap.
Extremely. And Tether also said they plan to issue USDT directly on Bitcoin using this new RGB protocol.
So combining the biggest stablecoin with Bitcoin's layers.
It's huge. It positions Bitcoin not just as digital gold, but as a genuinely competitive rail for global value transfer. Massively expands its utility. And layer 2, the Lightning Network itself, is just exploding. We're talking an estimated reach of 650 million potential users now in 2025.
Wow.
Transaction volumes are surging. Some platforms are doing $1.5 billion a month. The network capacity, the amount of Bitcoin locked in public channels, is over 5,000 BTC now.
Is it actually making money for people running nodes yet?
Yes, that's the crucial part. It's becoming commercially viable. Cash App's parent company, they reported earning a 9.7% yield on their corporate Bitcoin just by routing payments efficiently through their Lightning node.
So it's not just experimental anymore. It's a real business.
It's concrete adoption, proving profitability, which in turn incentivizes more people and companies to build out the infrastructure. It's a virtuous cycle.
And underlying all this, improvements to Bitcoin's base layer are helping too, like Taproot.
Absolutely. Taproot adoption has surged, went from like 1% to nearly 39% over the past year.
Why the jump?
Because it delivers real benefits. More efficient transactions, lower fees, better privacy through things like Schnorr signatures. It makes the base layer work better.
So it sounds like all these pieces, Taproot on layer 1, Lightning on layer 2, RGB on layer 3, they're not separate things, they're fitting together.
Precisely. That's the synergistic evolution. The base layer improvements enable better second layers like Lightning. And Lightning provides the speed and low fees needed for third layer protocols like RGB to really work for things like stablecoins and smart contracts.
So Bitcoin isn't just digital gold anymore. It's becoming a whole financial stack.
That's exactly the transformation we're witnessing. It fundamentally challenges that old narrative that Bitcoin can't innovate. It's becoming a multi-layered financial platform, and that dramatically expands its potential market, its possibilities.
Okay, wow. So bringing it all together for you, the listener, trying to navigate this deep dive really paints a picture of, well, two sides, doesn't it?
A clear dichotomy.
You've got the short-term choppiness, the volatility, driven by these big macro things, Fed policy, inflation worries.
Right, the headwinds.
But set against that, you have these incredibly powerful long-term fundamental tailwinds. The institutional money, the regulatory clarity emerging, the tech evolving.
Yeah. And just to reiterate, that consolidation we're seeing now, it feels healthy, constructive even. It's letting the market build a much stronger base.
And the drivers seem different this time.
Absolutely. This bull market, unlike previous ones, is supported by a much more diverse, much more resilient set of factors. The institutional flow, the infrastructure build-out, the regulatory progress. It suggests that these macro-driven dips are likely to be seen as buying opportunities by serious long-term players.
It really hammers home how Bitcoin's moving beyond just that simple digital gold label. It's morphing into something way more complex, more capable. Maybe the next time you see those scary headlines about a price drop, you can look a bit deeper. Look for the signs of how the actual network, the ecosystem, is getting stronger, more integrated, more useful.
That's the bigger picture.
It really makes you wonder, if Bitcoin is becoming this full financial stack, what kind of new possibilities does that open up? Things we maybe can't even really imagine yet. That's the question I'll be thinking about.
The provocative thought to end on.
Well, thank you for joining us for this deep dive. We really hope you feel more informed, maybe a bit more equipped to make sense of this ever-evolving market.